Hi students, this is a quick explanation of what's going on in Chapter 7. A few people had asked me to go over the difference between our two different methods for the allowance for doubtful accounts. So I'm going to do a very quick video on how you do that. So to begin with, I want to introduce you to Bob. This is our customer Bob up here. And let's assume that the company made a sale to Bob, customer Bob, in 2014 for $500. So 2 years ago, a sale was made to Bob, and in that time, or at that time, accounts receivable was booked for the amount he owed of $500, so the company will receive that later, and then the sale of $500 was also booked. So this is what happened back in 2014. Here we are in 2016, and customer Bob is nowhere to be found. We don't know where Bob is. We don't know where Bob's money is. So the problem is 2 years down the road, customer Bob has not paid. So Bob still owes $500. And logically at this point, 2 years have passed. It's a pretty good idea to say, you know, he's not going to pay. Let's just go ahead and write his account off so we're not sitting around waiting for it. Now, the problem, though, is that 2 years have passed. So if you remember from early on in this class, and a concept that was introduced early in Chapter 1 or 2, the matching principle. The matching principle means that revenues must match the expenses in the same period. It's kind of a confusing topic, but it's not that difficult to understand when you have a situation like Bob's. Bob had the sale to Bob happened in 2014. We can't wait until 2016 to expense the fact that he won't pay. We can't do that. We can't wait till 2016 because GAAP says we must follow this matching principle. So we must have revenues and expenses that go along with each other in the same period. So what we're going to do is we're going to estimate way back in 2014. We're going to estimate the amount that will be uncollectible back in 2014 and expense it in the same year. We'll estimate that amount that's uncollectible, the amount for the sale to Bob for $500. We'll estimate what portion of that is not expected to be collected, and then we'll expense it in the same year. So we'll go ahead and make an expense. So we're going to introduce two different main methods here on how to do that. How do we estimate the amount that's uncollectible? There are two main ways to do this, and I put little notations here on the problems I'm going to work from our textbook. They're also part of the homework that go along with these methods. So let's do the first one, the income statement information method, and that method is really just going to be based on a percentage of sales or credit sales. Or even a percentage of total sales. The amount we're going to estimate as uncollectible will be based on a percentage of some type of sale. Okay, here's our problem from Quick Study 7-7. Warner Company's year-end unadjusted trial balance shows accounts receivable of $99,000, an allowance for doubtful accounts of $600. This allowance for doubtful accounts, this is the reserve, the expected amount to be uncollected. And we'll deal with this account in just a second. We make a journal entry. It has a credit balance, by the way. And sales of $280,000. The uncollectibles are estimated to be 0.5% of sales. So we're going to make a little adjusting entry as of December 31st to account for those uncollectible amounts. So this is the percent of sales method because we're going to do a percentage of sales. So I'll use my sales amount times the percentage uncollectible to get the estimated uncollectible. Help if I'm a better writer than that, but sales are $280,000 times 0.005, move the decimal over 2 times, and do the math on that. $1,400 is expected to be uncollected. After you've done the math, 280,000 times 0.005, you will get a total of $1,400. Okay, so this is the estimate of what's uncollected or uncollectible. What we're going to do now is put that into a journal entry, and let me show you what the journal entry looks like. All right, so this is the basic journal entry form. We have our date. This is a new type of account I want to introduce you to called the bad debt expense. If you haven't read the textbook yet, then this is new. If you have, then great, you know what that is. But bad debt expense is the expense for those accounts that are uncollectible. And that'll be $1,400, what we solved for. And then the allowance for doubtful accounts is the account. This is the reserve account for how much that we don't expect our customers to pay. And that reserve account will have a addition, because we're going to add to it $1,400. So when you use this method, when you're using income statement information, the percent sales method, the amount that you estimate becomes the addition to the allowance for doubtful accounts. And I'm going to abbreviate that. Add the estimate, whatever you come up with, to the allowance for doubtful accounts. Okay, and so let's look at another method, and this is going to be based on balance sheet information. When you use balance sheet information to make the estimate for the allowance for doubtful accounts, you're either going to use a percentage of accounts receivable, whatever the balance is, or use an aging schedule of accounts receivable. It's based on the outstanding amounts for your customers and the percent expected to be uncollectible from each category of the outstanding balance, and then summing those up for a total amount. I'll let you review that in your textbook. But when you use balance sheet information, you're either going to use a percentage of accounts receivable, or you're going to use a schedule like the one I just showed you. So let's look at Quick Study 7.6. Quick Study 7.6 says, Warner Company's year-end unadjusted trial balance shows accounts receivable of $99,000, allowance for doubtful accounts of $600 credit, and sales of $2,800. And uncollectibles are estimated to be 1.5% of accounts receivables. This is different. We're not doing on sales anymore. We're doing on accounts receivable. If you haven't noticed, this is the exact same information we just looked at, but we're going to use a different method. So now we're going to prepare the year-end adjusting entry for the uncollectibles using this method. Okay, so for this method, we're going to take our accounts receivable balance. So I'm going to take the accounts receivable and multiply it by the percent uncollectible. And in this case, accounts receivable was $99,000, and I'm going to multiply it by 0.015. So move that decimal over 1, 2 times. And I get a total of $1,485. Okay, now this method that we're looking at, this balance sheet information method, using the percentage of accounts receivables or the aging schedule, is different than the one we just looked at. Because whatever we come up with for the estimate, that needs to be the ending balance of the allowance for doubtful accounts. So if I refer back to the percentage of sales method, whatever we calculated became the estimate we added to the allowance for doubtful accounts. When we use the balance sheet information way, with the percentage of accounts receivable or aging schedule of accounts receivable, whatever we come up with, we need to make that the ending balance for the allowance for doubtful accounts. It's not going to be an addition. We're going to make this the ending balance. So let me show you what I mean. The problem tells us that there's already a balance of $600 credit in that allowance for doubtful accounts. Okay, so here's a T account to help us with this problem. In the allowance for doubtful accounts, there's already a $600 beginning balance. But what we just calculated, using a percentage of accounts receivable, we calculated there needs to be $1,485 as our estimate to be the ending balance for this allowance for doubtful accounts account. So even though we started with 600, we want to end up with 1,485. So the entry we need to make, the adjusting entry, is not as easy as the one we did before where we just make a journal entry for the estimate. This time we need to find the difference between the two. What do we need to add to 600 to get to 1,485? We need to add to it $885. This is the entry we're going to make, $885. Okay, so whatever we come up with the estimate, that needs to be the ending balance we need to solve for the entry. Our entry is going to look just like the entry we just did using the income statement information, except our amounts will be different. Our entry using the percent of accounts receivable method will be the amount that we found was the difference from the current balance of $600 to get us to the estimate of $1,485.